RBI Monetary Policy. Understanding the Essentials. Introduction. Hello everyone, I'm Prakash Pandya and welcome to the maiden episode of Professional Primer. Today we're diving into one of the most important aspects of India's economic framework, the Reserve Bank of India's monetary policy. Whether you're a business owner, investor, student, professional, or simply trying to understand why your loan emmys change, this video will break down the key concepts of RBI's monetary policy in simple terms. What is monetary policy? At its core, monetary policy is how the RBI manages the money supply and interest rates to achieve specific economic goals. Think of it as the accelerator and brake pedal for our economy, speeding things up when growth is needed or slowing down when inflation becomes a concern. Primary objective: price stability with growth. The RBI's paramount objective is maintaining price stability, in other words, controlling inflation. This is crucial for preserving the purchasing power of the rupee and providing a stable economic environment for businesses and individuals. India follows what's called a flexible inflation targeting regime. The government, in consultation with the RBI, sets an inflation target currently 4% with a tolerance band of plus or minus 2%. This means the RBI aims to keep inflation between 2% and 6% over the medium term. While price stability is primary, the RBI doesn't ignore economic growth. Monetary policy decision aims to support sustainable development without compromising the inflation target. The Monetary Policy Committee. So, who makes these crucial decisions? That's where the Monetary Policy Committee or MPC comes in. This six-member committee includes three officials from the RBI and three external experts appointed by the government. The MPC meets at least four times a year, usually every 2 months in April, June, August, October, December, and February. Decisions are taken by majority vote, with the RBI governor having a casting vote in case of a tie. After each meeting, the MPC announces its decisions and provides insights into their rationale, ensuring transparency in the process. Key monetary policy instruments. Now, let's look at the tools the RBI uses to implement monetary policy. Repo rate currently 6.7%. This is the rate at which commercial banks borrow short-term funds from the RBI against government securities. It's the primary tool for managing liquidity and signals the RBI's monetary policy stance. When the RBI lowers the repo rate, borrowing becomes cheaper, encouraging economic activity. Conversely, when inflation is high, the RBI raises the repo rate to make borrowing more expensive. Reverse repo rate currently 3.35%. This is the rate at which the RBI borrows money from commercial banks. It helps absorb excess liquidity from the banking system and is typically used to cap inflation when it's rising. Standing deposit facility currently 5.75%. This tool allows the RBI to absorb liquidity from banks without providing collateral and acts as the floor of the liquidity adjustment corridor. Cash reserve ratio or CRR currently 4.7%. This is the percentage of a bank's total deposits that must be maintained as reserves with the RBI. Changes in CRR directly impact the amount of money banks have available for lending. Statutory liquidity ratio or SLR currently 18.7%. This is the percentage of a bank's net demand and time liabilities that must be maintained in safe and liquid assets like government securities, cash, or gold. By adjusting the SLR, the RBI can influence the amount of credit banks can extend. Marginal spending facility. This is a penal rate at which banks can borrow overnight funds from the RBI against their SLR securities in case of emergency liquidity shortages. Open market operations. These involve the RBI buying or selling government securities in the open market to inject or absorb liquidity. Monetary policy stance. The monetary policy stance indicates the overall direction the MPC intends to take. An accommodative stance signals that the RBI is willing to cut rates to support economic growth. A neutral stance indicates the RBI is keeping its options open. Calibrated tightening suggests the RBI is likely to raise rates gradually. Withdrawal of accommodation implies a move towards tightening after a period of accommodation. How monetary policy affects the economy. Monetary policy works through several channels. 1. Interest rate channel. Changes in policy rates influence other interest rates in the economy, affecting borrowing costs for businesses and individuals. 2. Credit channel. Monetary policy affects the availability of credit. For example, a lower CRR increases the funds available for banks to lend. 3. Exchange rate channel. Interest rate changes can influence capital flows and the exchange rate of the rupee, affecting trade and inflation. 4. Expectations channel. The RBI's communication and actions influence expectations about future inflation and interest rates, impacting economic behavior. Real world implications. Let's consider some practical implications. When the RBI raises rates to combat inflation, your home loan MAs may increase. When rates are lowered to stimulate growth, businesses find it cheaper to borrow for expansion. Changes in monetary policy can affect stock market performance and bond yields. For importers and exporters, monetary policy decisions can impact currency exchange rates. Conclusion. Understanding RBI's monetary policy helps you make informed financial decisions, whether you're planning investments, taking loans, or running a business. It's one of the most powerful tools for economic management in our country. Thank you for watching this episode of Professional Primer. If you found this helpful, please like, subscribe, and share this video. You may like to join our WhatsApp and Telegram channel by the name Legal Updates and check out our weekly newsletter on Substack for insights on AI and its intersection with various fields, including finance and law. Until next time.